Hello everyone and welcome to my renovation top 10. Today we're going to be talking about housing market. I received many emails regarding the housing market and if we will be a collapse in 2022 in the housing market. Everybody these days is concerned about the economy and about the housing market. This concern started last month with 7.5% inflation. By the way, this 7.5% inflation with the new metrics for calculating the inflation rate. If we use the old metrics for calculating the inflation rate, probably the inflation will be in the range of 15 to 20%. But by the way, this is not our subject for today. Our subject is the housing market. So how is the inflation is going to affect the housing market? In a very simple term, when the inflation goes up, so the Federal Reserve has to bring it down. And in order for them to bring it down, they have to raise the interest rate. Last month, the Federal Reserve said that they will raise the interest rate in March, which is this month, 3 times. Every time was 50 basis meaning 0.5%. So they will raise the interest rate by 1.5% this year, 2022. The invasion of Ukraine created instability in the financial sector. The stock market going all over the place, up and down. The major issue that will affect the housing market is the oil price. I want to show you what happened to the oil price today. What you see here on the screen is the crude oil in the past 5 days. You see the prices going up and down, up and down, up, but the trend is up and it's up too high. That's in the past 5 days. So let's look in the past 1 year. 1 year, I don't have to say anything. Look at the trend, it's going up. Like a year ago, the crude oil in March 1st, 2021, with about $60. Today is 106. So let's look over 5 years. Again, 5 years ago, it was about $49, 48.49. Today is 106. Now let's look even longer. Here you have a day on March 2014 that it hit 105. But this is the day that is concerning me, March 2008. We all remember what happened in March 2008. The national financial system collapsed over the summer of March 2008, launching a severe worldwide depression on November 4, 2008. So what was the reaction of the oil price? World oil prices skyrocketed from about $90 and reached $140 a barrel by June. Finally hitting a record of 104 or 147 a barrel on July 11, 2008, before collapsing and then going down to $40 a barrel around December 2008. What happened today is concerning me. I know that the Fed today is a lot smarter than 2009. They learned a lot from the financial collapse in 2009. But still, the invasion of Ukraine, it wasn't on the equation. Now the Fed, I'm sure they are meeting, they're trying to figure out how to deal with this situation because all what was in their head is to reduce the inflation by increase the interest rate. As I said, 50 basis each 3 times this year, so 1.5%. This 1.5% will tighten the economy. So how did we reach this point with very high inflation? Because the country was closed for 2 years, the Fed try to hold the economy in place. So they apply the quantitative easing. So what is a quantitative easing? Quantitative easing is a form of unusual monetary policy in which central bank purchased longer-term security from the open market in order to increase the money supply and encourage lending and investment. So the central bank purchased long-term security so they can release the money supply. When they release the money supply, then people will buy, people will go and have mortgage, interest rate is low, so the economy will start to move and the economy start to go up. So the central bank used quantitative easing to create money and use printed money to purchase assets. Remember, guys, when the country was closed, we used to get these checks in the mail and everybody was so happy, extended unemployment at $300 extra per week for people who do not work. All of this money created a huge problem in the economy and created the inflation that we are facing today. And now the Fed, they are trying to solve the problem by quantitative tightening. How are they going to apply the quantitative tightening? By increase the interest rate. A lot of people, they own homes that they can just afford to pay the mortgage. So when the interest rate goes up, so the payment, it will go up also. So these people, they were not going to be able to afford their homes, so they're going to leave it. When they leave their homes, it's going to be a lot of homes on the market, so the price will go down. But how is the price going to go down? The price will not going to go down immediately. The price will go down gradually. Also, I just want to mention something. When I said price will go down, I'm talking about the national average price. I'm not talking about certain neighborhood, because certain neighborhood might go up and different neighborhood might go down. But here we're talking about the national average price. I'm gonna show you how the interest rate is gonna affect if the Fed insists in raising the interest rate by 1.5% this year. What you see here on the screen is a mortgage calculator. Let's say a house for $800,000, 10% down. So the loan amount will be $720,000. And today's interest rate is 3.5%. That's if you have a good credit. That's over 30 years. Start date today. And the property tax, let's say around like $2,400. And the PMI, or the private mortgage insurance, is 0.5%, home insurance 1,000, and HOA, I'm gonna just say a 0, but most likely will be like a couple hundred a month. And this is conventional mortgage. And here you're gonna buy a new home, and let's calculate that. So the price will be $3,800. And let's say the Fed will increase the interest rate by 1.5%. Once the Fed increases the interest rate, automatically the mortgage rate will start to go up almost with the same number. So 1.5%, so this will be 5%. Remember this number here, 3,800. And let's keep everything exactly the same and calculate. 4,450, from 3,800 to 4,450. So it's $650 more per month. As you saw in the mortgage calculation, if the interest rate went up by 1.5%, then the mortgage price for a house, $800,000 with 10% down payment, will increase by $650. $650, this number, a lot of money for a lot of people. So what will happen here? What will happen is the people who own the bigger homes and they can afford their homes, they're going to start to go and purchase a smaller homes, and they're going to leave their big homes. So the big homes price will go down, but the smaller houses, the price will be stable for a long period of time. Why? Because we have already shortage in homes, and people who owns bigger homes, they're going to start looking for the smaller homes. So when they start looking for the smaller homes, then it's going to even be shorter supply for smaller homes. So the smaller home will be stable in price. So why the smaller home also will be stable in price? Because the cost of building rises with the inflation. So how are they going to build something new with less money than it cost them? So that's why the price for smaller homes will always be stable. But the price for the bigger homes, for sure, will go down. Well, I hope that this video explains what will happen to the housing market in the next, let's say, 6 to 8 months. Please don't forget to subscribe. Thank you so much, and talk to you in my next video, and goodbye.